Hi everyone, this is Dr. Nitin Choda, and in this episode of Ignition Time, I'm going to teach you how to invest with a 6-month perspective, a 1-year time frame, a 5-year and a 10-year or longer time frame. Yes, I said 10 years or longer. Now, before you watch this video, I recommend you watch the other video on my channel where I talk about the 3 principles of wealth creation. I also go over exactly how you should be spending your money. So I do recommend that you watch those fundamental training videos before you come to this video. I've also done another video on how to invest $1,000. So I do recommend you watch those first because they'll help you build a foundation before you get into some of the principles here. For me, money is not just a financial game, it is also an emotional and a psychological game. Now, the reason I say this is because there are 2 things that really tend to sabotage us when it comes to investing money for the long term. The first is short-term gratification, and the second is what I call self-sabotage. Now, what do I mean by short-term gratification and self-sabotage? When we are investing money, most of us have a need for short-term gratification. In other words, there's a need to make profits as quickly as you can. There's a need to double your money in 6 months if you can. There's a need to invest in something that you don't really understand in the hopes that it will generate a profit quickly. So that short-term gratification is in general not a good thing. And again, I'm speaking from my personal experiences. Money is a deeply personal subject for all of us. And also the short-term capital gains tax rate is significantly higher. You'll pay much more if you buy and sell, let's say, a stock within a short-term period, which is defined as less than a year. You'll pay significantly more income tax in most situations than you will if you sell the stock after holding it for longer than a year, because then you pay long-term capital gains tax. So the short-term gratification aspect, the need to make a quick profit so you can buy a car, or so you can do something with, spend that money and do something with it. That is something that holds us back from being long-term successful investors. Remember, an investor is somebody who generally invests for the long term and who builds wealth. If you're trying to double your money in a few months, you're not really an investor. And you might think you're an investor because, it sounds cool to say, hey, I'm an investor, but you are essentially a gambler. I don't want my subscribers to be gamblers. I want all of us to invest for the long term. So the short-term gratification thing is definitely something that holds us back. I also want to talk about self-sabotage. And this gets a little bit deeper, so I'm not going to go too deep into it, but I will cover it more at a superficial level. A lot of us have a bad relationship with money. And I had this myself. So again, this is my personal experience. Take it for all it's worth. If you don't agree, feel free to just skip this section of the video and go forward. But a lot of us have what I call as a self-sabotaging relationship with money. We fundamentally don't believe we are worth a lot of money. We fundamentally have a ceiling, if you will, of a number, if you will, of how much we are worth. A lot of us, because we are low wage earners and middle income earners, we don't make more than $20,000, $30,000, $40,000 a year. And so for us in our mind, that's all that we are worth. So if you ever end up in a situation where, let's say you get a large bonus, or you make a quick profit in the stock market, heck, I don't know, you win the lottery, or you get an inheritance. If you get a large amount of money, you don't know what to do with it. Part of you says, hey, I don't know if I deserve this. And then we spend it, then we blow it, then we lose it, we get scammed. This, by the way, is one of the reasons why lottery winners tend to lose most of their earnings, most of their winnings, I should say, a few months or a few years after they've won the lottery. So this phenomenon of self-sabotage is actually very real. I've experienced it in my own life. I was poor for a long time in my mind, even when I had money in my bank account, and I became rich in my mind after I came to terms with how to use money and how to make money work for me. So again, you have to be rich in your mind before you can be rich in your bank account. So I'm just, being honest and sharing my personal experiences with you. So now let's talk about investing for 6 months, 1 year, 5 years, and 10 years. Let's start with 6 months. And let me just set the record straight. Investing for 6 months is not investing. I'm going to repeat that again. Investing for 6 months is not investing. If you're going to put in your money into something and you want to hold something for 6 months, I personally don't consider that investing. I believe that you should set aside 6 months worth of savings, 6 months worth of necessary expenses in a bank account, and you should have that as a financial buffer, a nest egg, if you will, if any emergencies come up. And I have talked about this in other videos. So step 1 would be, don't try and invest for 6 months, rather have 6 months of expenses set aside in a checking account or a savings account. So make sure that you have that set aside. That would be step one. Step two would be, now you say, all right, do I want to invest for a 1 year horizon, 2 year, 5 years, or 10 years, and so on and so forth. Now, why did I pick 1 year? 1 year is actually the threshold. It's that cutoff point, if you will, between short-term capital gains and long-term capital gains. So here are some basics which you probably already know, but it's important to always go over the basics and remind ourselves about them. When you sell an asset for more than what you paid for it, the difference, the result, is what's called as a capital gain. A short-term capital gain results from selling assets owned for 1 year or less. Now, what do I mean by assets? The assets could include stocks, bonds, precious metals, real estate, and any other kind of property. Long-term capital gains result from selling assets that have been held for longer than a year. Now, short-term capital gains are taxed as regular income according to the US income tax brackets, and long-term capital gains have more favorable tax treatment and are subjected to lower taxes compared to short-term capital gains. So I'm going to quickly show you the difference between short-term capital gains and long-term capital gains for individuals who are single and for individuals who are married filing jointly. On your screen right now, you'll see a chart for long-term capital gains. If you've held something, if you've held a stock for longer than a year, so let's say you buy Apple for $300 on the 1st of June 2020, and then you sell Apple for $400 on the 2nd of June 2021, that would be considered long-term capital gains. So that profit that you made would be subjected to long-term capital gains. Now, if you look at the chart on your screen, if you're a single filer making less than $40,000 a year, this is the interesting part. Your long-term capital gains in this situation would be zero. If you are a single filer who makes between $40,000 to $441,450, your long-term capital gains tax would be 15% of the profit that you made. Now think about that. Think about the significant tax advantage that you get when you hold something for longer than a year. Now let's say you had the exact same situation, but you sold the Apple stock not on the 1st of June 2021, but you sold it, let's just say, in the middle of May 2021, so just under the 1 year mark. In that case, you would be subjected to short-term capital gains. Now, if you, let's take a look at the short-term capital gains tax rate on your screen right now, and you'll see that that same individual who was making less than $40,000 a year, now if they made less than $9,875, these are numbers for 2020, that person would pay 10% as short-term capital gains on the capital gains that they made. So let's say they made $10,000. They would have to give 10%, they would have to pay 10% as short-term capital gains. Now, if that individual made between $9,876 to $40,125, that person would have to pay 12%. And if that person made more money, then that person would have to pay 22% if they made up to $85,525. 24% if they made up to $163,300, and 32% if they made up to $207,350. And you have similar numbers for individuals who are married and file jointly. And for individuals who are married and filing jointly, let's take a look at the long-term capital gains chart. Very surprising here. Married filing jointly in the year 2020, making up to $80,000 married filing jointly. If you sell something and you have long-term capital gains, your long-term capital gains tax is zero. Now think about that. And if you're married filing jointly, making from $80,000 a year all the way up to $496,600 a year, your long-term capital gains tax rate is just 15%. Let's look at the short-term capital gains tax rate. If a couple married filing jointly make between $19,751 to $80,250 in the year 2020, they would pay short-term capital gains of 12%. And these rates go up from 12% to 22 to 24 to 32% to 35%, depending on how much an individual makes. So as you can see, when you sell something and you make short-term capital gains, you have to pay significantly higher short-term capital gains tax compared to the long-term capital gains tax, which are much more favorable. You are in effect giving yourself a raise when you sell something and when you hold on to it for a longer period of time, which is what I fundamentally do. So as you can see, I'm a big fan of long-term investing. investing more than 1 year. Now, when should you invest for 1 year, 5 years, and 10 years? It really depends on your own personal circumstances. If you need the money a year later, you've got to plan ahead and say, okay, I'm going to invest in something that's safe, something that potentially pays a dividend, something that's likely to grow with time, in companies that I understand, in companies that I appreciate. Investing should be about putting money in companies that you understand, not the movements of the stock market, because I guarantee you the stock market will go up, it'll go down. The stock market could go up beyond your wildest imagination, and it could crash, leaving you completely burnt. I believe that you should invest in companies that you believe in and companies that you invest in, even if their price goes down. In fact, especially when their price goes down, because now you're buying those companies on sale. That's how I approach investing. So now, should you invest with a 1 year, 5 year, or 10 year perspective? It depends on your own personal situation. I can talk about me personally. I have a 5-year plan, a 10-year plan, and a 20-year plan. Like you probably know, I have young children, so I have a 20, 30-year plan for my children. I also have a 5-year plan because 5 years later I have some other financial goals and I have some other things that I want to achieve. And I have a 10-year plan. I know exactly where I want to retire. I know exactly where I want to be 10 years from now. I know exactly the type of house I'm going to buy. I know exactly the type of car I want. And so I have a long-term plan and I have specific financial targets. In fact, my financial targets are in a spreadsheet, and I know exactly month by month, year by year, where I want my goals to be. And those goals are extremely, extremely ambitious. I usually create very ambitious, big goals, because then I force myself to work harder, to work smarter, to be able to achieve those goals. And I would encourage you to do that as well. For example, let's say you have $2,000 in your bank account today. You could set a goal for yourself and say, a year from now, I want to have $10,000 saved in my bank account. 5 years from now, I want that number to be $30,000. And 10 years from now, I want that number to be $150,000. You need to set goals that are ambitious, yet within the realm of possibility. Now, you're probably asking yourself, I can't see myself at $150,000 in 10 years. And now I can cover that in a separate video, but with the compounding power of money, when money compounds, you'll be surprised with how money compounds when it starts building upon itself. Albert Einstein said that compound interest is the most powerful force in the universe. Those who don't understand it pay it, and those who understand it earn it. I can tell you that the way I've built my financial fortress, if you will, is by understanding and by leveraging compound interest, and I want you to achieve the same, and I will help you achieve the same. I created this channel to help you, my subscriber, and I will help you get there. Thank you so much for watching. If you learned something new from this video, please click the like button below. Please also smash the notification button after you click subscribe, so you get instant updates from me about future videos from the Ignition Time channel. My goal is to help you ignite your wealth, to help you get to the next level. I release videos at 2 p.m. East Coast time most days of the week. So stay tuned and make sure you jump in and comment early, because that's when I stick around to comment and to engage with my community. Our community has been growing very rapidly, and I am ever grateful to all of you, to each and every one of you. Thank you so much. Once again, please click like, please click subscribe, please enable notifications. I'll see you in the next video. I appreciate you. Bye.